Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 21st of May. I'm Daniel Lam, your host for the podcast. No doubt many of you have heard of the concept 6 degrees of separation, i.e. only two people in the world, or matters in this case, are linked within a 6-step connection. Now, in my media interview earlier this week, the anchor asked me about my thoughts on allocating away from bonds into equities, given the elevated bond yields. So my response was very clear. It is nearly impossible to say that one asset class can be immune from factors affecting other asset classes, given the connectivity of investment instruments. In this case, rising bond yields will lead to higher discounted rate being used to value equities, and that would also impact equity prices. Now, there are fundamental connections as well. Take, for example, the key theme of AI. The effective closure of the Strait of Hormuz and ongoing energy shock can challenge the optimism to AI. Major chip makers have indicated enough stocks of critical inputs to last them a few months. So this was the assumption that the market participants have been working with since the breakout of the war at the end of February this year. But this prolonged conflict now raises questions on the supply of critical material such as helium and sulfuric acid, and large tech companies' ability to continue to absorb rising costs. Now, higher energy prices imply more expensive capex and potential deployment delays, impacting suppliers and regions hosting AI clusters. Power availability is a greater constraint for hyperscaler capex and data center expansion more than labor shortages, and that can lead to higher sourcing cost and margin pressure. Investors, they're getting fatigued by the lack of concrete and genuine de-escalation between the US and Iran, such that the risky assets are having smaller and smaller risk-on moves when we had supposedly positive developments in the conflict. Now, over the more medium term, the main concerns would revolve around the likelihood of a drop in investment spending on AI. Now, back in 2022, when there was energy crisis following the Russia-Ukraine war, investments held up, but tech companies chose to move data center investment to energy-rich locations. So these measures to improve the resilience of AI companies following that energy shock are likely to mean that data center investment is now less vulnerable. But historically, oil shocks have lowered the rate of technology adoption by companies and led to a drop in productivity growth because companies facing higher operating costs cut back on tech-related investment. So the impact has been more severe during supply-driven oil shocks, as well as during periods of already heightened economic policy uncertainties. Of course, the cleanest way out is a quick resolution of the conflict. Certainly, the political pressure is on Trump to try to end the war as quickly as possible. But we all need to be aware of the risk out there and adjust our portfolios accordingly. For example, by diversifying and avoid over-concentration, and have the ability to take up risky assets at bargain prices should we face a correction in the near term. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.